Hello and welcome to another episode of Niche to Necessity. Today we have a special guest. We have Phil Gaudiano. He is one of the co-founders and partners over at Chainwise CPA and also at Chainwise Crypto Academy, where they educate folks on how to do their own crypto taxes, but also folks that want to get involved in the industry. So welcome, Phil. Thanks for joining us.
Hey, thanks for having me, Taylor.
So I wanted to touch base with you to check in on kind of some of the upcoming changes that we have from a regulatory standpoint. We've got a lot of things in the pipeline, a lot of things that are kind of still up in the air and maybe not, we don't have full clarity on quite yet. But as far as the upcoming 1099 reporting requirements that will impact the tax year 2025, how do you think that these will affect the crypto industry? And can you just kind of give us an overview on what those entail?
Yeah, sure. Well, this all stems back from 2021, the passage of the infrastructure bill. And in that bill, it mandated that there was going to be what's called broker reporting that was going to be expounded down onto crypto exchanges and crypto brokers. Broker was a broadly defined term, basically capturing anyone who touches crypto, really. And so went back and forth with industry experts in Congress and committees and things like that. And they finally landed on a little bit of a narrower definition, but still a pretty broad one. But the upshot is that for all trades that happen, or really for all transactions that happen after January 1st, 2025, which is coming up in 2 months here, they have to be reported on a 1099, a new form 1099 called a 1099-DA. And that's going to be required to report gross proceeds from the transactions. And then the next year, beginning in 2026, reporting basis information and things like that. So it's an effort by the government to simplify crypto taxes. I'm not sure that it's going to meet that mark because there's going to be a lot of inherent work that has to be done in reporting what's on the 1099 versus what we calculate when we're doing the crypto tax calculations. But that is what it's meant to do, is to simplify it. And so that's really what the big talk is right now, because it's going to be a lot of papers coming in the mail or delivered by email. And and we're going to have to, it's an official tax form now. It's a 1099. So we've got to show it on the return. And a lot of the information is probably not going to be correct or might need to be, manipulated or changed somehow. So it's going to be a lot of work coming down the pipe.
Yeah, so when we got some of the final broker regs, I know that there's a lot of confusion around what works for centralized actors versus decentralized actors and what the different reporting requirements. Can you touch base a little bit on that and what those differences are?
Yeah, so for now, the IRS they kind of kick the can on DEXs and a lot of DeFi stuff because the regs say that brokers have to report, provided that knowing the information that they're required to report is part of what they normally do or would be required to do. So it's another way of saying essentially centralized exchanges definitely have to begin reporting, right away in 2025. But decentralized exchanges, DEXs, DeFi platforms, things like that, the IRS needs more time to assess what they can require them to report based on what kind of information they collect from their users. And they're going to pass regulations there at some point in the future. We don't know when that'll happen. So for now, DeFi kind of gets a buy.
Yeah, because it seems like based on the requirements, it seems like it would fundamentally upend the ethos of DeFi and a lot of the principles that go into why these tools were built originally. So the thought of having to report on every transaction on a place like Uniswap, for example, when you don't have to, it's meant to be permissionless, right? So it opens up a whole can of worms. And it almost, when I first heard about these, I was like, oh, sounds like the US is going to be at risk of getting geo-blocked out of using some of these portals, or you'll just have clone portals continuously popping up that may get shut down, but it's just computer code that you can keep copying and moving to a new server or something like that. So there seems like there's some flaws with the decentralized reporting of this. And I think that's part of the reason why they're kicking the can down the road. But it's all interesting stuff, Yeah.
Yeah. As it stands right now, DeFi is not set up for this at all, right? If you think about tax reporting from an IRS perspective, every transaction that occurs, whether it's in crypto or whether it's in stocks or whether it's selling your house or your car or whatever, all of that is tied to a person ultimately, right? A person with a social security number, a tax ID number. The ethos of DeFi is that you don't need that, right? There's no KYC when you go on Uniswap. There's no identity of any of the users, right? All the transactional data is there, but we just can't tie it to an individual. So it's going to be, impossible, at least very difficult, if not impossible, for most DeFi platforms to incorporate this without, like you said, without fundamentally changing how they do business. So yeah, it's going to be interesting to see where the IRS lands on this. We're waiting with bated breath because it could have a huge impact on the DeFi industry.
Yeah, I think it kind of underscores the need for additional clarity on, what type of entities these are in a lot of cases, because, in the example of Uniswap, it's a foundation that provided the initial code and things like that, but the actual app can run on its own without any outside input. So,
right.
It's like if you're gonna implement these rules and then put penalties in place, who are you going to penalize? And so the enforcement aspect of this is muddy as well. So yeah, I think that it's all going to be a challenge. And like you said, we need more clarity here, and we need to understand better, or have better rules as to and exceptions as to what needs to be required of these DeFi platforms.
Yep, I agree.
Yeah, and so with regards to these 1099 DAs that are going to start coming out, I'm less concerned because I think that the crypto brokers, they're gonna have to figure that one out on their own. But as far as investors go, or people that might be receiving these, what are some of the ways that they can prepare for the reporting challenges of receiving a bunch of these? Or is there anything really that they should be doing to kind of set themselves up for success in dealing with these new reporting requirements?
Yeah, well, first and foremost, you're still going to have to do a crypto tax calculation, right? The nature of crypto is such, and everybody that's in crypto knows this, but part of the appeal is in the portability. You buy a coin on Coinbase, you transfer it to cold storage, you transfer it to another wallet, you throw it up on Uniswap and trade it. There could be 6 or 8 different steps between when you buy and when you sell, and so the question becomes, how does the exchange where you sell it know what you paid for it? And in a lot of cases, they won't, even though they'll be required to provide that basis information on the 1099. So that's where we get into this kind of rigmarole of expecting a lot of the information on these forms to be incorrect, right? I think the gross proceeds will be correct because that's going to be based, just essentially it's going to go to some sort of aggregator site, CoinGecko, CoinMarketCap, or something like that, and just take down, the price of ETH at, 12 p.m. on October 25th or whatever the date is. That part's fine. But as far as the basis, it's going to be, a different level of exactitude that's going to have to happen to calculate that. And it's going to have to be done at the individual level. So when we look at this in terms of reporting, where this all lines up on the tax return, now we've got amounts that traditionally have not been reported on 1099 forms. Traditionally, we put them down on the lower lines of both the short-term and the long-term capital gains summary on Schedule D. Now we're going to have to move them up into the lines where they are reported, and then we're going to have to report the basis that's reported, and then we're going to have to back that basis out and then report the correct basis. So it's going to be a couple of hurdles to get through on the reporting side as well. But the bottom line is, if you're a taxpayer, if you're actively involved in trading crypto, I think it's going to be a while, if ever at all, before you can actually rely on these forms for anything aside from just gross proceeds.
Yeah, and I actually, it's interesting, you bring all that up. Like the gross proceeds part, as you say, it's the easiest part to source. But I was running an example just to illustrate how important it is to get this basis information right. And I ran an example, and this could be magnified by a lot more than this, but I ran an example where an individual bought 2 Bitcoin back in 2021 for a total of 100K, and then sold those 2 Bitcoin for 150K. And if you don't have your proper basis of information and you're, let's just say you're single and had no other income, it could be a 65 times difference in how much tax you pay or more, based on how big that trade is, if you don't have proper basis reporting. So it makes a huge difference, and it's really important to get all this stuff right. And kind of that leads us into my next question, which seems like it's another attempt for the U.S. government, the IRS specifically, to improve upon their reporting, though I don't know how effective it's going to be with implementing wallet by wallet reporting. At least now you have the lots in each different wallet. What kind of challenges do you foresee with folks implementing these? I've started to reach out to some of the crypto tax software companies to see how they're going to be handling it. And I haven't gotten too many responses quite yet. I think they're still working through how they're going to do that. But what types of challenges do you foresee with your own clients and in implementing this wallet by wallet reporting?
Yeah, well, the big challenge is that historically it hasn't been done this way, right? Historically, we've taken kind of this global or universal perspective where a digital asset that's owned by a person is owned by that person. It's not owned by that person in some sort of silo, right? The wallet by wallet guidelines tell us that now we have to separate this all into each wallet or each account if you're talking about an exchange or something like that. And then we have to go through and allocate basis to each of the assets in each of the wallet. And there's a revenue procedure out now that gives us a couple of methods on how we can do that. But primarily, from a historical perspective, all of a person's crypto generally is muddled up and mixed together. And now we have to break it all apart and assign basis based on which wallet it's in. So there's some decisions that have to be made relatively timely too, because you kind of have to make a decision on how you're going to do it by January 1st of 2025 or before you sell any sort of crypto assets. So if you're an active trader or something like that, you kind of got to get this done, in the next couple of months. But yeah, as far as the software limitations, there's a lot of softwares out there now that allow for wallet separation or for depot separation. They've got different terms, but it doesn't really tackle the initial allocation of the basis that you have. And so that's just comes down to math. At the end of the day, it's just a big math problem where we have to look at historically all of the activity in the account, what still sits in the account, and then put all those assets into the different wallets where they exist in the real world. So it's a lot of it's labor intensive. It's math intensive, and it's not all that logical to completely shift systems of doing this, because now, at this point, we've been doing this for, since 2014, since the revenue notice came out in 2014, which said that, crypto is taxable. So people have been doing the universal method for 10 years. And now all of a sudden you've got to flip a switch, in 2 months and get this all figured out. It's a lot of work. It's a lot for anyone involved. And if you violate the safe harbors, which is a couple of methods that the revenue procedure gives you, the IRS says that they can, levy fines and penalties and things like that. And we don't yet know that there wasn't a whole lot of detail given on what those penalties might be. But, it could potentially allow the IRS to go back in and recalculate their own gains and losses and lead to higher taxes for you.
Yeah, I think there's going to be a bit of a trap here as well for folks that were reporting, maybe they were filing their crypto taxes, but either their CPA or themselves weren't checking their basis against what actually was in their wallets at year or month end or whatever, at period end. And I think that there's a lot more CPAs and folks that are serving this industry that aren't checking that and aren't doing a reconciliation of what the actual basis was and how many units of crypto you had in that wallet at year or month end, that I think that this is one of those moments where it's going to be exposed because you're going to have to do that math. And if the math doesn't math, then you're going to have to, either go back and amend because you're realizing that the data that you provided to them previously was incorrect, or, you might have to eat some of those penalties in a current year or whatever. So I think there's a lot of stuff that's going to, expose people with regards to this transition. And it just underscores the fact that if you're you need to either be working with someone that knows what they're doing or educate yourself to the point where you can get it right, and not educate yourself to the point where you know not enough to get yourself in trouble, but not enough to do it right. Right? Kind of gotta.
Yeah, exactly,
Yeah.
exactly. And it kind of speaks to, software limitations, and it speaks to the level of knowledge that's needed in general, right? Because it's easy enough to sign up with, coin tracking or Coinly or, a Bitcoin trader or whatever, and hook up all the APIs and all your wallets and then get some sort of report populated and call it good. But is it really good? Chances are, that there's a lot of work that has to be done behind the scenes in terms of, tying out ending balances, seeing if there's any missing transactions or something like that. But a lot of the industry right now is just focused on, getting the raw data into the software and taking whatever the software spits out as a valid report. And so if that's been your habit over the last, 3, 4, 5, however many years, you're going to be in a world of trouble when you need to go back in and figure out exactly what you have and exactly what the basis is, and then make a decision on how to allocate that. It's going to be difficult for a lot of people.
Yeah. So, switching gears a little bit to kind of year end and, more like positive, like how do I reduce my tax liability at the year, with year end approaching? What are some tax saving strategies that investors can implement now, before year end to either limit or kind of mitigate how much tax they pay for the year 2024?
Yeah, well, this kind of dovetails with what we were just talking about, right? Because the big tax saving strategy is tax loss harvesting. We all know what that is. Basically, you go through your portfolio, you look for the losers, you sell the losers, and those losses can offset some of the gains that you have elsewhere in your portfolio. In order to do that, you need to know what's in there, right? So you kind of have to do these calculations and figure out exactly what you've got so that you can make those decisions on what to sell. Other strategies, that's a tried and true strategy that applies to, crypto assets, stocks and bonds, mutual funds, all that good stuff. And that's kind of a classic year end strategy. There hasn't been a whole lot of losses this year, at least in the larger coins, but I'm sure you can find some, particularly if you bought, in 2021 or something like that, and you
Mm.
still carry this super high basis. Um, Aside from that, there's charitable giving, which is becoming more and more popular. There's an increasing number of charities that are accepting crypto donations. So that's an easy enough avenue to do. I always just caution people there that if they contribute more than $5,000, they have to get a qualified appraisal in order to be able to deduct that on their Schedule A. So make sure you're talking to your tax pro. Make sure you know what the requirements are. And if you're making any larger gifts, make sure you get a qualified appraisal, or the IRS can just say, no, it's not valid.
That's great. And so if someone does donate to a charity and let's say it's under that $5,000 threshold, do they still have to pay capital gains on that disposal, or is that, how does that work?
Generally speaking, no. Generally speaking, it's going to be capital gain property, right? Which means that the gain isn't recognized, right? It's the same way that it works with appreciated stock, or appreciated anything, right? You could donate a car theoretically to a charity that appreciated in value. You get the higher write-off value of it. It's just that cars generally don't appreciate; they go the other way. But yeah, in generally speaking, you can save yourself the capital gain there.
So you would get both the capital gain and the deduction on your return potentially based on if you file Schedule A.
Yeah, yeah,
Great.
yeah, and that's a good point. That the requirement to deduct the charitable contribution is that you file a Schedule A, which is itemized deduction. So make sure that you're above the threshold there to qualify to itemize. Otherwise, it's all a wash. It won't matter.
Yeah, cool. Well, those are the questions I had for you for today. I really appreciate you joining us today, Phil. Your expertise is always well needed and well appreciated. So thanks again, and we'll keep in touch and get more of your face on some of our calls and things like that.
Great. I look forward to it. Thanks for having me.
All right, Phil. Have a good one. Take care.